Well, good afternoon, everyone. I'm Christina Wiley, Executive Director of the New York MBA. And on behalf of our president, Jody Gaines, welcome and thank you for joining us today. Before we start, I'll review a few housekeeping items. If you're having any difficulty with technical issues, please use the chat function to notify us. Today's webinar and all lines are muted, or during today's webinar, all lines are muted except for our presenters, of course. We encourage you to ask questions throughout the session by using the chat function or Q&A. All questions will be visible unless you select to share the questions with the panelists only. The slide deck presentation will be available and forwarded to all attendees after the webinar. At this time, I'm happy to introduce Kathy Kanchowitz and Lisa Cheney, who head up MBA's Education Committee.
Good afternoon, everybody.
Hi, everyone.
Well, I'd like to have the pleasure of introducing our speakers today, Steve Baselice and Mark Teteris. Steve Baselice serves as a capital market solutions specialist at Optimal Blue, a division of Black Knight. He has been at Optimal Blue since 2018 and holds 3 decades of experience in the mortgage business. Prior to Optimal Blue, Steve was vice president with the private equity firm Global Mortgage Capital. He also spent 18 years building and successfully managing a secondary marketing desk on the origination side of the mortgage business, allowing him to gain firsthand knowledge of the challenges that come with selling loans into the secondary market, as well as the day-to-day demands of managing a locked desk. Our other presenter, Mark Teteris, is a certified mortgage banker, CMB, began his mortgage industry career over 20 years ago and has held roles in sales, originations, and executive leadership. As Director of Solutions Specialist at Optimal Blue, now part of Black Knight, Mark leads a team of subject matter experts who consult and deliver a sophisticated suite of secondary marketing data and data analytics and compliance solutions across the industry. So without further ado, I'll turn over the presentation to Mark and Steve.
Great. Well, thank you very much, Lisa and Christina and Kathy. Thank you so much for having us here today. And we are happy to join you and get things kicked off with our webinar. So up on the screen, I'm just showing the highlights of the agenda. We'll talk about economic and operational benefits of selling mandatory. We'll get into fundamentals of managing locked pipeline interest rate risk and hedging. We'll provide an example of best execution and loan sale strategies. We'll talk some about the counterparty relationships that are needed for mandatory delivery. We'll get into secondary marketing policies, some best practices that we'll share, as well as discuss accounting considerations and conclude with some tips on succeeding in a mandatory model. So let's start with just a few stats up on the screen, and I'm showing these just to give you an idea of just kind of the breadth of Optimal Blue within the secondary markets writ large, partially because we're going to be sharing some statistical data with you that we derive through the Optimal Blue systems, and just wanted everybody to know that that data is based on a very large market sample, as you can see by the statistics up on the screen. So in this slide, to talk a little bit about what's happening with lock volume. This is one of the things that Optimal Blue tracks. So these are indices based on the actual locked loan production that goes through the Optimal Blue product eligibility and pricing engine. This is tracked on a daily basis and reported on every day based on the previous day's volume. And the OBMMI, the red line, which is the Optimal Blue mortgage market indices, is showing in this case a 30-year fixed rate mortgage, what that interest rate is, and you can see we're up in that 6.3% plus area today. This chart itself just goes back 1 year. So in April, we were down, about 100 basis points lower in terms of the interest rate. And I think everybody will recall that, we started 2022 with, rates in the low 3s. So it was a very dramatic increase in rates, happened over a very short period of time. had a big impact on refi in particular, but also purchase volume. Much of that occurred over 2022 as those long-term rates doubled. And as was mentioned, I've been in the business for over 20 years, actually over 30 now. So I joined Steve in the 3-decade club here. But we know that as rates go up, volume goes down, and it starts to impact profitability as mortgage banking operations, try to kind of catch up and lower expenses and overhead as volume falls off. And this becomes very, very evident as we look at this slide. This is a report from the Mortgage Bankers Association, which saw at the end of 2022, the average cost of production rose to an all-time record of $11,219 per loan. That was during the second half of 2022. Actually, the fourth quarter, it peaked out a little bit over $12,000 per loan. And at the same time, productivity for both production and sales personnel were falling by 55% and 64% respectively. So just 27% of reporting firms in the MBA survey were profitable in 2022. And on average, there was a 13 basis point loss per company for 2022 as a whole. So a pretty tough backdrop, but that's a great reason to be thinking about if your company is in a position to be able to do so, to make that move from best efforts to delivery to mandatory delivery, to pick up some significant benefits, both from an operational and an economic standpoint. So let's begin with just a brief definition: best efforts versus mandatory, if you're not already familiar. In best efforts, we're as an origination shop, you're going to make your best effort to sell an investor a loan that you've locked in with them at a specific price, which is established at the time of lock. And that's typically at the same time, simultaneous with locking the loan with the borrower. And there's a significant amount of information required to create that registration and commitment. So you need loan information, you need borrower information, you need property detail. All of these are required at the time of lock. However, the plus of best effort delivery is that, if the loan ultimately fails to deliver, there's no penalty to the mortgage originator. So it's kind of a free put, if you will, or a no harm, no foul kind of situation. In mandatory,
Oh, you froze up there for
sorry,
a second.
am I back now? Okay. All right.
You're back, but you got to share your screen.
Sorry about that. Okay, let's see here. Let me get back to. Okay, can you see it okay now?
Yep, back
Sorry
up.
Technical issue. So I think I left off at mandatory delivery. Different workflow. The originator is going to commit the loan to an investor, but they're not going to do that until they actually have already funded and closed the loan with the borrower. And at that point, they'll commit to the investor that they will deliver a particular loan or maybe a group of loans at that point to an investor in an amount, type, and note rate for the price established at the time that the loan is committed to the investor. In that case, we know as the originator, we've already funded, closed the loan, we're going to be able to deliver in a short period of time. However, if for any reason we're unable to deliver, then there could be a mandatory pair-off fee that would have to be paid by the originator to the investor. So I'm going to kick it over to Steve to begin fleshing out some of those benefits of selling mandatory.
Yeah, good afternoon, everybody, and appreciate everyone joining us today. Yeah, there's a lot of reasons for why you would sell mandatory, and Mark and I are going to cover on two key things, which is the revenue side and the operational side, the efficiencies picked up. I know we always like to kind of start with the revenue side. I know people always want to understand that a little bit more, and that's really the ROI and the driver behind that. As Mark said, I haven't spent a lot of time running desk. I also believe the efficiencies are equally important, but Mark's going to touch on that. But let's talk focus right now on the revenue side of things. It was a couple of slides ago that we saw from the data from the Mortgage Bankers Association. It's been a tough year, toughest year in the last 20 and counting. And the reason why you would want to really look at mandatory now more than ever is picking up that additional revenue. I know everyone is trying really hard to increase their originations, and that has its own set of challenges. But one thing that really is at everyone's fingertips and the ability to make a difference right away is to make that move from best efforts to mandatory. You really just can't easily add originators and find loans out there. That's a challenge. But if you have the volume, and we'll talk about that a little bit later about when it makes sense for you to do that, picking up that extra best efforts versus mandatory spread is really important, and that is dependent upon how you sell your loans, whether it's be to the agencies, it's the aggregators. And again, we have some slides on some hard data that we have here at Optimal Blue that'll show you, give you an idea as to what that pickup is. The other thing is when you're selling loans, it's very important for the investors to be able to have a full transparency into the specs of the loans. Best efforts pricing really is a general pricing model, if you will. Look at mandatory as more of a sniper approach, and the best efforts is more of a shotgun approach, if you will. When investors could actually see the specifics of the loans, loan size, FICO, really drill down, they could give you the best possible pricing that comes with that. And the other key thing is when you do decide to hedge, it's very important that you select a hedge advisor that has access to all different types of executions that are available to you as the lender. We don't dismiss any execution type. Even though we talk about best efforts to mandatory, believe it or not, best efforts still shows up as being some of the better execution on a small percentage of times, but nonetheless, it's there. So you always want to be cognizant of looking at all execution types that are available to you as the lender, and be able to see that in real time, not just have access to it, but real time, and relying upon that data as being fully accurate. Also optimize and specified pay-ups. As a lot of folks on this call probably know, even doing best efforts, there's less than 250,000 in some certain state specific, New York being one of them, where you have a certain spec pay up that's associated with your business. Being able to capitalize that is incredibly important as well. Capturing unused lock duration. I've always been a big fan of this. Now, right now, it's really not as much of a factor as it traditionally has been in the past, because we have an inverted yield curve. An inverted yield curve has caused these dollar rolls. In other words, each TBA settlement from 1 month to the next, it's a smaller amount of a drop between the two. So the difference between a 30-day lock and a 60-day lock isn't necessarily as wide as it used to be. But many folks that are on this call have been in the business for a long time know that this is more of an anomaly than the norm, if you will. So that once that starts to become steeping, which tends to happen, you tend to have an inverted yield curve when the Federal Reserve is tightening credit, which they are doing right now, and possibly towards the end of that. Once they start to pause on policy, or even start to potentially lower rates, you start to see the yield curve become more of the traditional steepening, which in turn causes that lock duration to be more of a factor. Next slide, Mark. Yeah, and so this talks a bit about that best efforts to mandatory spread on a longer term basis. Like anything, it's volatile. It's something that is certainly market dependent. You could see here over the course of 12 months, pretty much where it's at. Right now, you see on the conforming side, it's pretty strong at greater than 30 basis points. You see, for the most part, there's a lot of times where it's between 30 and 40 basis points. And again, back to that mandatory versus best efforts spread being a real catalyst to making that move. This really could increase your bottom line in a tremendous way. not just for obvious reasons, but also for recruiting reasons. I remember when I was on the other side of the business, a lot of times when we were recruiting loan officers, they would ask, are you guys doing mandatory delivery? And why do they ask? The reason they ask is because then they kind of feel a bit more confident that they're going to be able to get the most competitive rates in the marketplace. Because if you're going out with best efforts rates to your sales force, a couple of things are happening. Either A, you're not maximizing your revenue, but you're also maybe not giving your loan officers the best possible price they can have, which, and certainly in a very competitive market that we're in today, is a big deal. Next slide. And this kind of gets into, I know this is probably not one of our prettier graphs, but darn, it's got some nice colors. I think if you stare at it a little bit too long, right, Mark, you might start to see like some images, maybe some dogs, or cats, or sharks or something. But what this is telling us is that, again, having a hedge advisor, having a hedging platform, you got to look at all executions, and it really is very dependent upon your business. But you could see here in some cases, which is indicated by the green line, even best efforts squeezes in there about 10% of the time. And our data shows that roughly speaking, we're talking about 10 basis points better in execution. So the thing is that when you are looking at your mandatory model, it's very important that when you are ready to sell your loans, that you are looking at every execution type that's available to you. Nothing should be dismissed. Nothing should not be considered. Everything needs to be taken into a centralized place and making your final best X decision. And having those tools to do that in real time with a few clicks of a button is challenging. And that's why it's important for you when you make that transition to work with a hedge provider that allows you to do that. And Mark, back to you to go over some of these very important efficiencies that are gained as well by making the move from best efforts to mandatory.
Great, thanks, Steve. Yeah, so let's start right out with the efficiencies that can be picked up by minimizing what I refer to as the chaos of the best efforts lock desk. And having run my own IMB back in the day, run a lock desk, I have these vivid memories of the initial registration and lock request would come in from a loan officer, and then the market may or may not be moving, and we got to turn around right away and open up the investors registration website, enter in the loan data, the borrower data, lock data, get that loan registered for that particular investor that was selected at that time, usually based because they were the best price for best efforts at that point in time, and get that loan locked. And then almost invariably, 10 days later, the appraisal comes in, or something else changed in the loan file. And now the lock desk has to, confirm the change and that it didn't impact pricing, within our own internal systems, but then also has to turn around and go on the investor website and perform the lock maintenance activity. And we actually have some data at Optimal Blue through some of our data and analytics products that show that on average, there can be as many as 5 changes to a lock while it's going through the manufacturing process that require this lock maintenance activity. So that's for best efforts. When you move to mandatory, that all changes, because while we're still accepting a lock or issuing a lock to the borrower, we are not going to lock the loan or even register the loan with a particular investor until much further down the manufacturing process. And so as a result of that, if there are changes to some of the loan parameters or qualifying parameters that might impact pricing as the loan is being manufactured, yes, we still have to make sure that that is maintained and kept up to date in the LOS, but it's certainly not something that we need to communicate or maintain on the investor side, because we haven't even committed to a particular investor yet. So So it really eases up a lot of pressure, frees up time for the folks that are working on your lock desk, allows them to concentrate on higher value activities. So that's number one, is that efficiency. And it's great for investors too, by the way, because on their side, they know that once a loan is committed to them on a mandatory on a mandatory basis, that they'll be receiving that loan. And so your pull through goes to approximately 100% at that point. So which is definitely a win-win for everybody involved in the transaction. A couple other things that we're able to do is create standardized underwriting guidelines. So this is something that doesn't even necessarily have to be done on day one of moving from best effort to mandatory, but it is something that is considered a best practice where you can modify your underwriting guidelines and procedures so that your underwriters are basically approving loans that are fungible. In other words, they could be delivered to any investor, or in some cases, because of some particular investor overlay, we may have to have an include-exclude mechanism, to account for those overlays so that we understand and built into our processes that we're only going to consider in our best execution analysis investors that are eligible to receive that loan from us. This next bullet point is a single set of lock policies. So if you think about, in the best efforts world, every investor has their own policies when it comes to relocks, extensions, renegotiations, and different price adjusters that might accompany each of those variables. So it's actually a lot. And if you've got 10 or 12 investors that you sell to on a best efforts basis, you could have 100 different Sorry, I think I might have had another technical glitch there. So anyways, back to having a single set of lock policies. At this point, your investors no longer kind of drive the ship. You're able to actually create your own policies, a single set of policies that your lock desk and your loan originators will all sing from the same playbook, if you will, and be able to much more easily understand that, yes, if I need to extend a lock by 10 days, this is, what the policy is, this is what the cost is, et cetera. And it's all your policies that you've written internally. And depending on how you set it up, can actually go from being kind of a drain on profitability to actually being a bit of a contributor to net revenue. So I'll move on to the next slide here. And we'll turn it back to Steve, talk about some fundamentals.
Yeah, again, all great points, Mark. And obviously we can't control interest rates, right? But what you can control is implementing these things that Mark just spoke about from an operational efficiencies, and of course what I mentioned about the economic side of things. And when you work with any reputable hedge advisor, you'd be surprised at how quickly this could be done. I know here at Optimal Blue, getting someone implemented could take a very short period of time, 30 to 60 days in most cases, with very little lift from your IT side, very little. And again, I'm sure that's the case with other hedge advisors as well. So understand this is not like implementing an LOS or something like that. It's a relatively painless process that's been refined over the years. And as we're talking about this, there are risks, of course, that are associated with hedging. I've always made the argument, even before I came to Optimal Blue, that doing best efforts is more risky than doing hedging. If you're utilizing a right hedging system, and if the person that's doing it is doing so in a prudent way. And the example I always use to that is how many people on this call, have had a lock that they forgot to expire on a Friday afternoon and only to have it repriced worst case on a Monday, right? And I don't know about you guys, but 9.9 times out of 10, it always seems like a reprice is a lot worse, right? Those type of things become very, very, very costly. But with a hedge advisor or a hedging platform, you are looking at fallout risk, you are looking at price risk and basis risk. Real quick, fallout risk is a loan not closing, of course. Price risk is having that loan move in a certain direction, actually both sides up or down at the time from the time it's locked. And then the basis risk is how you hedge that position and whether or not that hedge is working in tandem with the price movement of your loans. Again, any reputable hedging platform should have strong analytics around these first three that could really look at historical pricing to predict future behavior. The one thing that, quite frankly, and if any hedge advisor out there tells you otherwise, they're kind of misleading you, is product risk. Anyone that's been in this business for a long time knows that on occasion, whether it be the agencies who are much better at this, but an investor a little bit more likely to do this, where they just drop a program or a product with little to no notice, or change LLPAs or change an adjuster or things like that. Again, these are very, very, very rare instances, but I want to be crystal clear when it comes to product risk. If we're not given, or the industry as a whole is not given an ample amount of time, there's a risk associated with that. Next slide, Mark. All right, on this one, yeah, Mark's going to walk through the fundamental differences between how you handle your locks as they come in versus best when looking at best efforts versus mandatory.
Great, thanks, Steve. So we're going to look at 2 slides in a row here. So this first one will be the best efforts delivery timeline, and then the next one coming up will be the mandatory delivery timeline. The difference, in the graphic is fairly subtle, but I want to talk through, what the implications are. So this chart right here is just showing, what we're doing today in a best efforts, or what you might be doing today in a best efforts world. So we've got, day one is a loan is locked with a borrower. So at that point, we've created that market risk, right? So now I, as the originating firm, committed to a borrower a price and an interest rate for delivery at a future date. So I need to mitigate that risk. The way that I do that in my best efforts world is I look for the best efforts, best execution opportunity from amongst all the investors that I sell to. And then I go ahead and commit that loan to that secondary market investor. So that's at the very beginning of this red line here. And then I just start to go through the manufacturing process of the loan. And ultimately, if everything goes right, that ends up with the loan being funded to the borrower. I've now got it in my post-closing department, packaged up, and I go ahead and deliver that loan to the investor under that original best effort commitment. So that's a very simple kind of A to Z process, if you will, from a secondary marketing perspective. Now let's go ahead and look at how that changes when we move to mandatory. And we'll also at this point kind of call out some of the risks that exist as we go through the process. So I still have my day one. I'm issuing a lock commitment to the borrower. And there is, if I wanted to, I could just lock at best efforts, but I'm not going to. I'm going to put this loan in my hedge as an alternative to locking it with a particular investor. So now I'm managing the loan and the risk for fallout and also price movement as I'm manufacturing the loan. Then ultimately we get to funding. So now I've closed the loan, funded it to the borrower. So now I no longer have fallout risk. That's gone away, right? The loan is closed. But the market is still moving, every trading day. And so I'm still managing that price risk until I actually have the loan packaged, ready to go. And now I want to commit it and deliver it to a secondary market investor, at which point I'm able to take advantage of the best execution that's available for mandatory delivery at that point in time, And remember, at this point, I'm probably, 5 or 6 or 7, maybe 10 days away from actually delivering the loan to the investor. So it's a very short term commitment that I take out and deliver into that. So that's the timeline. Now let's talk a little bit about how to manage risk. I'm going to kick it back to Steve to talk a little bit about the definition of a hedge.
Yeah, there's a couple of key things here. I mean, I know we want to keep on time, so I'll move through these relatively quickly, but highlighting, of course, the key points, which is, what is a hedge? Really what you want to think about a hedge is taking off an offsetting position so that the price of the loans that you locked are protected in an interest rate market, whether pricing goes up or down. And in the mortgage business, we're very fortunate, which we could talk about on the next slide. On the mortgage business, we're very fortunate to have something called TBA, or mortgage-backed securities. Think about mortgage-backed securities, the pricing of a mortgage-backed security, that's where everything starts. So whether you're selling to Fannie or Freddie, or whether you're selling to some of the aggregators, everybody benchmarks off of the TBA securities as a start point. So of course, that would make a natural hedge, if you will, or a more precise hedge to the price of your loans. So the TBA market is a very fluid market. We'll show that later on in our graph. But there are a couple of alternatives that we always talk to our customers about when it comes to hedging a mortgage pipeline. TBA, of course, being one of the biggest ones, which we'll talk about here on the next slide. On the the TBA is by far the most popular, if you will, with folks out there when it comes to hedging a mortgage pipeline. It does provide greater flexibility in many cases. It's a very liquid market, so it's certainly you could rely on that being consistent. But for some folks out there that maybe just sell to the agencies, just sell to Fannie and Freddie, maybe what we call note rate hedging might work. So you could take out these note rate commitments that have a range of 50 basis points that you could slot loans into. That's a fantastic tool for folks that are just selling to the agencies to be able to hedge their pipeline. And then, what other folks do, a relatively small part, definitely no one from the standpoint of a best efforts to mandatory transition. This is utilized more so with some bigger lenders out there. They do choose to hedge with options or with swap futures. And just in talking about the size, I know this is a little bit dated, 21, but it's got the same essence, if you will. I've been in this business for over 3 decades. Started right out of college, and the mortgage-backed security markets is a very deep market, only second to the U.S. Treasury market. So what does this mean to you as a possible person making a transition? Is that, that, from a standpoint of the risks associated with all of a sudden having something disappear and go away, these are not problems that do exist when it comes to mortgage-backed securities. Now, that being said, there is volatility. There is some, price dislocation from time to time. Those things happen in a market, but over the long haul, there's a great deal of consistency by utilizing mortgage-backed securities for your hedge. And now I'll kick it back to Mark for some great examples of what risk management is all about in a day-to-day real-life scenario.
Okay, so here we go. So I promised an example. So let's go ahead and set it up. And we'll start with just a typical scenario. This is going to be very plain, very simple, just for illustrative purposes here. So in this case, let's say a loan officer, on behalf of their company, enters into a contract with a borrower. And in our example here, we'll use a $300,000 loan amount with a 5.5% interest rate, closing in 3 months. And let's just, for simplicity, we'll just say that the current price for that 5.5 loan is par. And so what will happen is we issue the lock commitment to the borrower. The lock desk then, remember, we're not going to lock the loan with an investor. We're going to put this into our hedge position. So the way that we do that is the lock desk will enter into a short position in TBA coverage to cover that 5.5% loan at a price of par. So ultimately, by doing this, that position should guarantee the loan officer and thus the borrower, the 5.5% rate in 3 months at that par price, regardless of where prices go. So a $300,000 total value, no matter what happens in the outside interest rate market during that point in time, during that period of time. So let's go ahead and talk through the impacts of that, what it would look like. I'm going to ask Steve to go ahead and walk us through this scenario.
Yeah, so looking at a rising rate in my take two. Looking at a rising rate environment, you'll see the opposite impact, right? Your price of your loans go down to 99, so there is a quote unquote loss of value. But then your hedge is going to recognize that $3,000 gain, because remember, when you're hedging, you're selling. So whenever you sell something and then you could buy it back at a cheaper price, that's a good thing, right? If you sell a stock short and then you buy it back cheaper, you make money. So that's that offsetting component there. And then what it comes down to it is the bottom part there, which is showed in this green color, which is that it's market neutral. And that's the key thing is, I can't stress enough when I talk to customers, about this, and some people are certainly nervous about it, is, hedging is not gambling. Hedging is managing a risk that's embedded in the market, that you're able to get that extra revenue and pick up those greater efficiencies. And if you're managing it correctly, which we'll show in maybe the next slide, Mark. Oh, this is going up. Okay. So yeah, so this is a scenario where we'll tackle that in 1 second, but this is showing where on the other side of the equation, where if the price of the loans actually goes up, right, you're going to make additional money when you go to sell that loan. But again, you're buying back your hedge. And when you buy back your hedge, what you are going to do is there's going to be a loss of revenue there. So again, an offsetting component where ultimately the net is zero. So what we just showed you on these last two graphs is the whole concept here from hedging is that, quite frankly, the secondary marketing person really doesn't care if the market goes up or down. I used to always joke that I always liked when the market rallied because everyone was in a better mood, but it really didn't impact my activity or my profitability or my consistent delivery to the corporate side from the standpoint of producing that additional revenue that's gained by mandatory. So the key thing here is focus on the green line, which is the consistency regardless of the market going up or down.
And I should probably add just one note. We say the net is zero, which is great. But remember, the whole reason that we're doing this is that I am going to get the net plus the best efforts to mandatory spread. And by having that hedge in place, I've protected that additional spread plus my day one margin, whatever I have built into my price sheet.
That's right. Not to mention all those efficiencies you mentioned earlier, right, Mark?
Exactly.
All right, so let's talk a little bit about how to manage the risk. Again, really important that you pick the right vendor for one, and we'll touch on that also later on. But having a dynamic fallout model. Any again, reputable hedge advisor out there is certainly has a battle tested system, but don't ever be afraid to ask questions as to how they come up with whatever it is that they come up with. A key driver for almost any hedge model is where that loan is in its stage or milestone, depending upon what you call it. Those are the biggest factors involved in hedge pull through, as well as, the delivery channels. Certainly a retail channel may have a different or will have a different pull through performance than a wholesale channel, different FICO scores and so on and so forth. All these things are very important for your hedge advisor to consider. If they're not part of the model, you should be asking why. Also having a live model, being able to have the new locks consistently coming into the system. It's very, very important that you work with a hedge advisor that is able to update your position in a real-time basis. If you're only getting updates once a day, twice a day, that's not enough. Markets move, there's too much volatility. So being able to have a hedging provider that gives you updated information is critical to having peak performance. Years ago, committing loans wasn't necessarily a component in a hedge pipeline and a hedge platform. However, that's changed over the last handful of years. Now a hedging system not only needs to hedge your pipeline, but also needs to be able to sell your loans. And being able to utilize, like we talked about earlier, all those different delivery methods. So that's also a critical part, a critical component to making that decision as far as, what hedge advisor to use. And last but not least, reporting. What good is all of this if you can't report this information up to the C-suite, up to your CFO, up to your president? Having not just real-time reporting, but also having reporting that's customized to your business. Next. Sorry, I'm getting all choked up talking about this, Mark. It's so dear to my heart. But how to manage risk. I know what we do at Optimal Blue is we'll look at your historical data going back as long as 2 years. And the key thing is you allow the data to do the talking, if you will. Allow that data to be processed, allow the data to be utilized to allow the system to anticipate future performance. We talked about loan stage being a critical driver. We also have a bullet point here. What matters most is predictability, not normal performance. So being able to get very granular and being able to really dig into your business, because everyone's hedge model is different. But the way your borrowers perform, the way your branches and loan offices perform, all that is unique to you. And if you don't have a system that's able to customize the way your business is, you can't be put in a box, if you will. So having your data being the biggest part of your pull-through dynamics is the driving force behind having ultimately a profitable performance.
Great. So now, once we've gone through and hedged the position, we've gotten our loans to closing, it's time to deliver. That's where this, that Steve touched on here, is being able to understand what the best available execution or loan price is available when in the marketplace when you go to sell your loans is critical, because that's where ultimately where the revenue is made. And so there's some important keys here, and one of the things that a hedge advisor will do, I know we do, on a really regular basis, is to compare the different investors out there. We see from our desk, virtually every investor in the marketplace, and so we know who's winning, who's losing, who's got a strong bid for what particular types of loans. And we're able to share that information with our clients within the hedge advisory group, so that they are making sure that they're maximizing the investor roster that they sell into, and then making sure that every component of pricing is incorporated into that best execution analysis. So understanding, the buy up, buy down grids, the loan level price adjusters, the SRPs, any special incentives, as well as any fixed fees for delivery of the loans, and something that we refer to as a value factor. So if, and just a quick example of that, if you have an investor that you deliver loans to because they've got, the best looking price that they show you on the screen, but then, they have a large percentage of kickbacks that, never get bought by that investor, or they have, sort of post-funding delays and price penalties, that front end price might not actually represent the true value. And so you can build in adjusters to that within your loan execution or loan sales system. So being able to rank executions by investor and by delivery method, and then all of this is dependent upon, an extremely high degree of accuracy, which is where the automation really, really kicks in. And having integrations with the pricing engine as well as with the LOS is really critical to make it, as well as with the investors. So all that comes into play as we get into the loan sale and best execution analysis. So I'm going to segue here into some of the counterparty relationships. So, sort of number one, and you've heard Steve and myself talk about it, is just, choosing a reputable hedge advisor. There's a number of them out there. We like to think of, ourselves at Optimal Blue as being among the best. And that's just due to, having a long time in the business. We have a deep market expertise, actionable data and analysis tools, the technology that we've invested in to bring to the marketplace, and this probably shouldn't be underestimated, just having a real commitment to communication and to training is really important, because we're really working in a partnership, if you will, to achieve the success for our clients. And then this last bullet point, data integrity and robust reporting. So these are all things that can, should, and must be delivered by your hedge platform for you to accurately manage your position in a real-time way. So counterparty relationships, I touched on this earlier, just having an optimal investor mix with the right type of approval. So when you start talking with your investors, that maybe some of them that you might be selling best efforts to right now, and you can talk about the transition to mandatory, which I encourage you to do. Talk with your account executives to make sure that they can convey to you all of the options that you have for mandatory delivery. So there's flow mandatory, there's the bulk bid tape, there's direct trade. So these are all important things to discuss with investors, and a hedge advisor can of course help provide market color and even shadow bids to determine which investors you might want to consider adding to your lineup. Another important counterparty is the broker dealer. So this is where you trade the TBAs. So this is the secondary market. Broker dealers, there are two types. There's broker dealers and there's primary dealers. The primary dealers tend to have higher net worth requirements, sometimes some really high volume requirements. Most shops, when they make the initial move from best effort to mandatory, are going to be dealing with the regional broker dealers. And so this is a case where, as the hedge advisory firm, we're able to provide all of those introductions, really help get through the approval process, which is relatively painless and quick. It's much quicker to sign up with a broker dealer than it is with a typical investor, for example. So we establish trade lines. And you can see up on the screen, this is just a screenshot from our system, kind of showing, some of the broker dealers that an account might be using, showing their total available line amount, what they've got outstanding, and therefore what they have remaining available credit on a particular line. So this is something that we help you with, and we work with every one of the broker dealers and primary dealers that's out there. One other important one to touch on in counterparty relationships is your warehouse lender. There's just a change in the workflow, and I can guarantee you that your warehouse lender is already familiar with folks making the move from best effort to mandatory. They've already done it before. So if you contact your warehouse lender, let them know that you're looking at making a move from best effort to mandatory and talk through that process. The biggest change is that, unlike in the best effort world, where at the time the loan is submitted for funding, you're requesting funds from your warehouse bank and you have to deliver a copy of the investor commitment pre-funding, so that they know that that loan has already got a buyer on the other side. When you're delivering mandatory, you won't have that pre-funding investor commitment because you haven't decided yet who you're going to sell the loan to when you go out to get the run the best execution analysis. So in those cases, the substitute, if you will, for that investor commitment is going to be okay, I'm going to reshare my screen. I see I just had a technical drop there. Sorry about that. And just to repeat, in case it didn't come through, the hedge position report from your hedge advisor is essentially the replacement for the pre-funding investor commitments that you won't have. And so warehouse lenders are familiar with those reports. They know how to read them. We work with warehouse lenders on a daily basis.
All right,
So
excellent.
let's move it on.
Yeah, a couple of things, Mark, on the next ones. Talking about helping clients, and again, any hedge provider should be able to do this. Is when you are making the move to mandatory delivery and hedging, it would require policies and procedures around that. Whether you work for a bank, an IMB would provide it for a warehouse bank, and so on and so forth. But rest assured, you're not going to have to write that from scratch like I had to back in the old days. We would I know we would help you with that. And again, I'm assuming other reputable hedge advisors would be able to do that as well. So having those policies and procedures in place are very important. Next, from the standpoint of hedge considerations, yeah, it is different. Bottom line, when you lock a loan best efforts, you just, as Mark showed earlier about the fundamentals of how that works, is when you lock at best efforts, you lock it at the time the borrower's locking the loan with you. With hedging, you put it into the hedge, and ultimately it gets delivered into a commitment. So from a standpoint of hedging, it's certainly a different way to look at it. You have more of a mental shift of, as we say in here, is getting away from that loan level price into a more aggregate approach. One of the key things too is when you are working with your hedge advisors to be able to, provide your account department with a mark-to-market reporting. Also have certain liquidity management tools in place to manage your broker-dealer mark-to-market as well. All these things are very, very important when making the decision and moving to mandatory. And the last one here that I'll kind of talk to, and I'll hand it back to Mark, is from a standpoint of, we gave you all this great stuff. And by the way, happy to have more personalized conversations for those out there that are interested in learning more about specifically about their business. We're obviously speaking a little general here, but happy to have those one-on-one conversations. But we talk about a readiness evaluation. So, when can I do this? When does this start to make sense? First of all, the minimal net worth is important. 2.5 million, that's pretty much aligned with the agency approvals. The volume, the ROI has to make sense. And we always kind of encourage clients that are doing, we encourage you to start looking at it when you're north of 5 million. In other words, start to vet it, start to learn more. But really, when you start to get to that 10 million a month business, that's when it really starts to kick in pretty good and very convincingly. And that is also, we're looking specifically at loans that you would hedge. So anything that would not be part of a hedge, like a jumbo, or maybe those one-off, one of those, if you have an arm or something where you're locking that best efforts, that's something you want to take out the equation. Or for some of you banks out there, anything that you're putting into, putting on your balance sheet, if you will. From a personnel standpoint, you really should have a centralized lock desk. There's a lot of folks out there maybe that, I know we talk to where the loan officer locks the loan with the investor. Those are things that you would be getting away from. But the key thing is you gotta have delegated underwriting. If you don't have delegated underwriting, if you're kind of pigeonholed on whoever you sell it to, they have to underwrite it, you're going to need to get away from that. And the economics are very, very compelling to do that, because keep in mind that when you do have delegated underwriting, you are paying in essence for an underwriter. The difference between the fee that the aggregator will charge for a delegated versus a non-delegated, it's pretty wide. It could be $700, $800. You add that up on a per loan basis, you see where I'm getting to as far as being able to go out and hire somebody to do that for you. With that said, kind of bring it on home. I'll hand it back to Mark.
Great, thanks, Steve. All really good stuff. And just a couple of things to kind of leave you with about succeeding in a mandatory model. Some of it's just mindset. A lot of times I think we've just been kind of stuck doing things the way that we know for so long that it's comfortable, and we're able to just continue on that way, but yet at what cost? And so, we kind of have to break through that, change the mindset in terms of, pricing, underwriting, best execution analysis. All these things, are going to be done, with a different goal in mind of delivering, a volume of loans that have already been closed and funded, as opposed to attaching a particular P&L number, for example, to a best effort loan on the day you lock the loan. You're really going to see it at the end of the process. And accurate data throughout is really kind of a bare table stakes. So you need to, be able to use technology to make sure you're reducing any redundancy or errors, that your eligibility and pricing models are all spot on and working accurately and in real time throughout the process and the manufacture of your loans. You need to really have an excellent model in terms of pull through that's able to analyze actual performance of your specific pipeline, as opposed to some kind of a generic idea of what pull through should be in a bigger universe. It all gets very specific. So ultimately, it's about best execution. It's about, relying more on reports and to understand your performance and profitability. And so with all of that, just, a couple of things to think about here. And these are things that, at Optimal Blue, we're particularly proud of, is obviously having the product and pricing and eligibility content in our system. We are the market leader for a reason. The system itself is web-based in real time, which provides, all of the benefits. We use the Microsoft Azure, and there's many benefits there. Everything from industrial strength, security, scalability, and redundancy. All of those things are benefits of being web-based and in the cloud, and being able to work in a real-time system. So we've got terrific integrations with the leading LOSs out there. Very important to be able to share that data back and forth. And that helps drive those robust reporting capabilities. And I think on the first slide, I mentioned we had about 350 hedge advisory clients. Those are built up over the years. Many of those are folks who, just like perhaps some of you in the audience, were best efforts when we first met. And we've take great pride in taking them through the process in a very consultative and collaborative way to make that move from best effort to mandatory and make it successfully, which we've done many times. And so with that, we'll see. I think we had one question come through in the chat that we responded to. If we have any others, certainly feel free to hit them, but I see we're at the top of the hour. So with that, I just want to thank everybody for joining us today. And Steve and I and our team are very open and happy to discussing further with anybody who'd like to, just run an ROI analysis or, have a deeper conversation, feel free to reach out. So we're here for, love to have those conversations with anybody. So thank you.
Thanks, Mark, and thanks to Steve. New York MBA appreciates Optimal Blue sponsoring this event for us and just for being a great partner with New York MBA. And if anyone on the call has questions, you can feel free to reach out to Christina, Jody, Lisa, myself, and thanks again for your participation. Have a great day.